This is Behind Closed Deals.
We'll be chatting with multifamily maestros,
Uncovering their strategies
and unraveling the latest market happenings.
Bringing you intel you can't buy.
Welcome, everybody, to Behind Closed Deals, Episode 2. I'm George Tickajohn, a member of the Midwest Multifamily team of Cushman and Wakefield. And joining me today is my colleague, Cameron Benz. And our guest today is Sam Tenenbaum, who's the head of Multifamily Insights for Cushman and Wakefield. He heads the multifamily research and thought leadership, and he leverages data from over 170,000 units that Cushman Wakefield manages, sells, lends to, and does construction management for, in addition to valuation and advisory services. So, Sam, welcome today. Thank you for joining us.
Thanks for having me. Pleasure to be here.
So let's start with one of the questions that's on everybody's mind with interest rates rising and markets unsure what's happening in the near term and midterm. When do you think the capital markets will thaw?
That's a great question, George. We recently, in our global think tank, which is a part of the group that I'm a member of, we recently put out a new paper that we call the Glide Path Report. I think the formal title is Glide Path to Clearer Skies, where we sort of lay out how the capital markets will flow and what events need to happen until we get to that point. So the sort of glide path until we get to the point where we start to see the capital markets resume some sort of normalcy, some sort of behavior like we're used to seeing. Because as you pointed out and probably know better than most, it's tough out there, especially with treasuries hovering in the 4.3 range today. I saw this morning. It makes it hard for real estate to offer competitive yields. And so for that to happen and for us to kind of see the markets thaw, first and foremost, we need economic certainty. We need some sort of certainty from the Fed, which is meeting this week on the path of interest rates. Hopefully they pause this week. We'll see, but they still are planning another 25 basis point increase by the end of the year. Once we have certainty on the interest rate front, we'll try and get some certainty on the economic front. And then from there, I think we can start to see the capital markets thaw. Historically speaking, this is a long answer to a short question, George, but historically speaking, we start to see activity resume and pricing start to pick up after the Fed reaches peak Fed funds and then starts to cut rates. So until we start to see rate cuts, I think it's going to be hard for the market to believe that rate cuts are coming. And that, I think, is the real trigger. And our view in the Glide Path Report is that Fed funds start cutting in mid-2024, early to mid-2024.
And what do you think the extent of the rate cuts will be, and how long will it take to get there? And using the 10-year Treasury, which even though the Fed doesn't control that, using the 10-year Treasury, what do you think the amount and the timing is of those rate cuts?
Yeah, so we see rate cuts coming in, and there's a few things that need to happen for that for the Fed to feel good about cutting rates. Right now, it's pretty obvious that inflation is still a little bit too hot. We're averaging kind of in the 3 to 3.5% range over the last year. We approached 3% a couple months ago. I found it very hard to break below that floor. And so if you remember back to your macroeconomic class, the Fed has two jobs, right? It's got price stability, so taming inflation, and full employment. And for the last, call it 6 months, a year or so, we've been hovering around 50-year lows with the unemployment rate. So we've done mandate 2, right? We've figured out full employment. We're there. we still have inflation that is well above the Fed target of 2%. So at 3%, 3.5%, we're 100 to 150 basis points above where the Fed wants to see inflation. And for them to feel comfortable with seeing inflation moderate, which we have seen. I mean, it's gone from 9% to 3%. So we've definitely seen the good direction come for inflation. But the reality is we're not there yet. And there are still too many signs that the economy could reignite. And I'm fond of saying that the shadow of Paul Volcker looms large at the Fed. And the reason I say that is because back in the 70s and 80s, we saw that double dip in inflation, or double heat in inflation. And that pushed interest rates up well above where they are today. And the Fed wants no part of having to do that again, because if they push interest rates up to 10, 12, 20% like they were a while ago, that creates real challenges for the U.S. economy in a way that it didn't. Not that it didn't create challenges back in the 70s and 80s, but it would create significantly more problems today given the size of the U.S. debt.
So do you think that it will be long enough before rates come down significantly enough that it will cause distress in multifamily real estate? In other words, owners of properties who are on floating rate debt or have maturities are hoping that rates come down in time for them to refinance their loans. What do you think what's the time frame? I mean, those who have loan maturities in 2024, you think it's too early and they won't be able to avoid problems?
It's a great question. I mean, I think it comes back to, look, if we see rate cuts, something has happened to the employment side of the mandate because inflation hasn't been fixed. And if that's the case and we're tipping into a recession, George, I'm not sure that the cost of debt will move meaningfully, because Fannie's investors who are investing via bonds or the securitized market, or if we're talking about banks and life companies and other sources of liquidity on the debt side of the equation, they're going to want an increased return as a function of the risk they're taking for lending or owning a bond effectively in a recessionary environment. And that it's not necessarily a problem, but I think if that's the case, I'm not sure that even if we start to see rate cuts, that the cost of debt, which is ultimately what we're talking about here, not necessarily where interest rates are, but it's interest rates as a function of where debt costs are. If those debt costs don't come in and don't move, there will be some distress. It's not to say that there will be no distress. It's not to say there will be a ton of distress, but the stat that I typically point to when this question gets brought up, because this is also a question that's on the top of everybody's mind in the industry, is how will there be distress? How much distress will there be? I'm in the camp of very limited distress. Some of it will be fairly high profile distress, as we've already seen, but right now there's $125 billion that's been raised over the last few years, specifically targeting residential. The next closest space that people are raising funds for is industrial, and there's obviously no surprise there. But that's at about $55 billion. So we're seeing more than 2x the capital raised for multifamily investment than we are for anything else, and that's not on top of all of the other diversified funds out there, which we can't track well because they can invest in anything, right? That's sort of the point of being a diversified fund. But the most likely deployment strategy, and you see this with all of the big institutions, is multifamily and industrial, given office's relative challenges. Retail, too, is interesting, but it's harder to deploy in the same way you can for multifamily. It's less straightforward than multifamily and industrial. And so I think you'll still see the capital prefer multifamily investment and industrial. And I think with that level of capital that's out there, the distress will exist, but it'll be relatively limited because there's capital waiting to jump in and buy these assets at a reduced basis. it's the classic economist answer, right? Uh, there'll be some, but it won't be a lot, but I can't give you an exact number. But you're right that the most acute issues are obviously that floating rate debt that was originated in 21 and early 2022, because interest rates have floated much higher than anyone initially thought at the time.
So, Sam, what do you think is more important for the future of our economy and for the multifamily space? Jobs, population growth, income growth? What do you think?
This is another classic economist answer. You're setting me up for all of the economist answers here.
Well, you are the economist, Sam. So
yeah, it's some combination of all three, right? Ultimately, what we're trying to get to is what creates new households. Obviously, if we're growing the population at an outsized pace, you're going to see just natural household formation as a function of that. It's sort of like an offshoot of that, as it were. Job growth, same thing. Income growth, though, ultimately, to me, is what we're really trying to solve for. Because, when we're talking about leasing a new apartment for a year, right? We're talking about renting a new apartment. You will need to see pretty significant increases in income for that to happen, for people to feel confident in making that financial decision. If maybe you're a roommate, and so maybe you're sharing a 2-bedroom apartment that was maybe $1,400 and $1,500 a month. So you're spending $750 to $800 a month, right? And that's fine. That's perfectly reasonable. That's a decent amount of money. But if you're talking about getting your own apartment, maybe we're talking about $1,200 or $1,300 a month. And that decision, you then multiply that by 12, because that's ultimately the amount of money you're outlaying. That's a pretty big financial decision. And so some of that is a function of, I got a new job, so I got a raise. But if you had a job and then you got a new job, that's not a net gain in jobs. That's maybe a shift in the job. That's not a net gain. Income growth is ultimately what we're trying to get at. If more people have jobs, that's more aggregate income that can go to renting apartments. And so I tend to lean a little bit more on the income growth. Ultimately, though, that's a function of how many jobs are we adding in particular areas, and there are lots of other proxies for that are, quite frankly, more highly updated from data sources than income growth is, at least in a way that is econometrically sound, to say the least.
It sure feels like we've had a lot of income growth here in Indianapolis over the past few years. And what I always think back to is Amazon advertising here a few years back, and it's $11, $12 an hour, and now all the billboards are 18 to 20. So we have had good income growth here so far. Hopefully we continue to see it in the future.
Yeah, that's helped the lower end of the rental pool, the lower priced apartments. We've seen big increases in rent and big increases in occupancies in the segment of the market that traditionally has been the toughest. And I think it's because of what Cam just described, the big wage growth, especially on the lower end of the wage scale.
Yeah, I mean, you think about, making $15 an hour is plus or minus $30,000 to $35,000 a year. You put two of those households together, because the median household size is 2.1 or 2.2. I forget the exact number, but it's in the low twos. So you put two of those incomes together, and all of a sudden that's $60,000. That's right in line with a pretty median priced apartment, and that's at $15 an hour. When we're talking about growing those jobs from, $11 to $20 an hour, that's a huge increase on a marginal basis. That's almost a 50% increase, right? So we're seeing huge wage gains, to your point, George, at the bottom end of the wage scale in particular, and that's driving a lot of growth in the renter pool too, because those folks at the lower end of the wage scale are probably not buying a home, especially not with 7% rates today.
Sam, with regard to rent growth, do you think the rent growth over the next 5 years on an annual basis will be any different than the longer term rent growth, say over the next 20 years? How would the more near term rent growth differ from much longer term?
Sure. So let's start by establishing what that long-term basis is. and then we'll talk about the near term. So over the last 20-ish years or so, we've seen rent growth average nationally about 2.5%, plus or minus a couple basis points. And that's through all cycles, right? So we've had a few up cycles, we've had a few down cycles in there. But over the last decade, which has been mostly an up cycle, and also has had one of the biggest outsized rent growth numbers we've ever seen, averaged about 3.6 or so over the last decade. So in an up market, you typically see somewhere between 3 and 4% rent growth. On average, though, we're at about 2.5% rent growth. So you can justify between probably 2 and 4% rent growth in any given year, but it'll fluctuate based on what's happening in that year. At a national level, in the next 2 years, my expectation is for pretty weak rent growth. I would say below that average. That's a function of the fact that there are 1 million units under construction, depending on what source you look at, but it's in the upper 900,000s to 1 million range. That's just a lot of new supply. That's about 5.5% of the overall US multifamily market. That will have an impact on fundamentals. It's not a function of demand. It's just that's a lot of new supply based on where vacancy was a couple years ago in the wake of the pandemic and a lot of those projects getting started. After that, though, we see deliveries falling off pretty hard in 26, 27, 28. Our expectation for deliveries is somewhere in the neighborhood of 50 to 75,000 units per year nationally, which is really low, considering the fact that this year we're going to deliver close to 350,000 units across the country, going from 350,000 units to 75,000 units, which is our expectation in 2026. That's a huge drop off. So I would expect the near term to be a bit weak, but then really ramp up hard in 26, 27, 28 as the supply wave crests and then falls off pretty dramatically.
Interesting.
Is that what you're seeing buyers underwrite? I mean, I live in the Sun Belt where that's a pretty common theme because we tend to see a lot of construction here and a disproportionate amount of the construction here. So when you're looking at underwriting from buyers, are you seeing them underwrite stronger outer year rent growth, or is it just kind of a straight line 3.5% or so?
Well, I would say one of the, I'm going to turn your question around a little bit. One of the reasons we've seen continued strong demand to buy in the Midwest and in Indiana as compared to the Southeast is because I think people are less fearful of the amount of supply coming online here. So they're willing to underwrite some rent growth, not as much as they were willing to underwrite a year ago. So as a year and a half ago, they were underwriting 3 to 7% rent growth. I think people are now back down to 3% and not willing to underwrite anymore. But I think that's better than negative rents that some of the Sunbelt markets with a lot of new construction is experiencing. So that's helped continue to drive demand to invest here.
Yeah. I mean, there's a lot. I'm not just saying this because I'm on your podcast, George, but there's a lot to like about Indianapolis as a market right now, and I think we're starting to see a lot of that national attention get pushed towards the Midwest in a way that it maybe passed over it for most of the last decade. There were faster growing markets, more exciting opportunities in the Southeast, development yields that were still really strong, and you could point to all of the population growth that these markets were seeing, and it's very easy to attract capital, right? Now, I think we're seeing a shift towards a lot more wage growth in the blue collar sectors, which is sort of typified the Midwest, average employee. And so because of where the wage growth is happening, and because quite frankly, a lot of that rent growth happened in the Sun Belt, probably at a faster clip than people thought and probably should have seen, because we're seeing some markets give some of that growth back in the last year or so. I think that has the Midwest as a whole is starting to see its time in the sun, as it were, and starting to attract a lot of attention as a function of that too. On the Indianapolis front, though, because I can't help but give you this fact, George. I was looking the other day in terms of long run demand and trying to think about where renters are going to be in the next decade plus, right? We're seeing demographic shifts and we're seeing population growth move in the wake of the pandemic. You know, this is a fun stat. So I live in Austin, Texas, and it surprised me to learn that today there are more 10 to 24-year-olds. So over the next decade, these will be your bread and butter apartment renters who will be 20 to 34-year-old, which is typically speaking the most average apartment renter today. Indianapolis has a higher portion of the 10 to 24-year-old population than Austin, Texas does. And
what do you attribute
there's
that
a lot
to?
of reasons for it. There's a lot of reasons for it. Austin tends to attract the geriatric millennial age cohort, and that it's a nice way to say the older millennials. Maybe not so nice of a way to call the older millennials, but it tends to attract a lot of the population growth for Austin has been folks in their late 20s, early 30s to kind of early 40s, and it's over the next decade. I would expect population growth to just continue to shift towards the Sun Belt. People will still move there. People will still move to the Midwest too because it's more affordable than your coastal markets that are 2 times more expensive than a lot of these markets at a minimum. That said, a lot of the population growth in Austin has been a function of people moving, which when they're moving in that age cohort, they probably don't have kids in the 10 to 24-year-old range, and so that's just why. So
it's kids going to Austin after college because it's a fun place to live, but then they start thinking about having families, and they want to come back to places where it's more affordable, and also it isn't 120 degrees every day, so they come back to the more moderate, temperate climates of the Midwest, and they have families here, and the families grow up, and so that's why there's 10-year-olds, because it's children of people who don't want to be burned to a crisp in Austin.
After this summer, it sure feels that way.
Okay, Sam. So we're gonna end the podcast with this final question. What concerns you the most? 2 questions. What concerns you the most about the outlook for multifamily, and then alternatively, where do you think the greatest opportunity is in multifamily?
Both great questions. I'll start with the second one first. The greatest opportunity, and again, I can't help but say this on your podcast, George, but I do think there is terrific opportunity in the Midwest. A lot of the rent growth that we've seen nationally has been in the Sun Belt, and then it kind of moved to the East Coast and the West Coast, and it sort of bypassed the Midwest, except for Indianapolis. Indianapolis has actually seen pretty strong rent growth over the past few years since the pandemic, and also has very limited construction. So you look at markets that tend to have pretty good demand fundamentals. We talked about the 10 to 24-year-olds over the next decade and where they are today. So you mix that demand with the levels of supply that are coming in the Midwest more broadly, but Indianapolis specifically, has tended to been glossed over by developers because it really was a local developer market. Most of the folks building there were, people who knew Indianapolis or knew the Midwest markets much better than someone parachuting into a Nashville or a Atlanta or an Austin and saying, I'm gonna build a building here. I don't necessarily understand the market at a fundamental level, or maybe they do, but they haven't necessarily put down as many roots as you would see in a less. This is, forgive the lack of terminology or maybe the off-color terms, a less sexy market in the Midwest or in Indianapolis, perception-wise. In reality, though, I think Indianapolis has a lot of long-term growth drivers. And if you start to then incorporate the fact that we're seeing an elevated level of work from home, an elevated level of remote work, and you start to do the math of, well, maybe people won't move as much over the next decade as they did over the past decade. And if that's the case, I want to be where they are today. I don't want to wait. I don't want to wait and bet on the fact that they're going to make this decision. I want to figure out where they are today, meet them where they are, and build apartments where they are. That to me is a really interesting proposition, especially for Indianapolis, which has a pretty good renter population that's coming of age now, and maybe doesn't have to relocate for a new job because they can get one of those fancy remote jobs and work from anywhere. And they chose Indianapolis because they grew up there. They know the people. They've got their family. They've got their friends. Maybe they went to school in Chicago but decided to move back. I think there's a lot to say for the Midwest as a whole in terms of growth over the next decade, on top of the fact that we talked about the blue collar wage growth story. And that, I think, is going to drive a lot of growth across some of these Rust Belt states, or formerly Rust Belt states, I guess, at this point. Excellent. And then the first question, because we can't not answer both questions for you. What concerns me the most? I grew up in the Northeast, so I'm inherently a skeptical guy by nature. So this question is my favorite question to answer. Yeah. The thing that concerns me the most today really is a recession. I mentioned the 1 million units we have under construction today. That is a lot of new units. Multifamily has benefited from the housing shortage. It's benefited from the national storylines around that housing shortage, and just generally the tight market we saw over the last couple of years in the post-pandemic environment. If we start to see the bloom come off the rose a little bit on the multifamily side because fundamentals start to erode, we start to see vacancies increase, we don't see rent growth show up as much as we thought it would, all of a sudden, maybe multifamily isn't where we want to place our capital, or as much capital as we thought. And some of that capital gets diverted away to other uses or other asset classes. And that to me is where things start to get a little scarier. I don't think that's my base case, or that's definitely not my base case. But, if we're talking significant job losses, that will have, I think, an outsized impact on the multifamily space. Only to be buoyed by the fact that, well, if interest rates don't move and we still have 7% mortgages, who on earth in their right mind is buying a home in that environment when the market is just so disjointed from the multifamily market?
So your concern is a deep recession, a mild recession. You're less concerned about impact on the multifamily.
It'll have an impact, but the labor market has been the big firewall against fundamental erosion in the multifamily space. And if that starts to weaken considerably, I think there's real trouble. If we see more of a rolling recession, kind of like what we're experiencing now, where certain industries go into recession, certain things go into recession, but broadly speaking, the aggregate economy doesn't go into recession, I think that is okay. The market can withstand it. But that said, if we see 5 million job losses, that's a lot of job losses, a lot of weakness in the labor market, which I am concerned about the impact on the multifamily market. There are reasons to be a little bit more optimistic and think that the multifamily market can be a little more resilient. It is, typically speaking, the housing of last resort. People have a lot of equity in their homes. They may choose to sell their home, try and cash in some of that equity, and then rent. But like we saw during the financial crisis, multifamily saw relatively minimal impact on fundamentals as a function of that recession. But there are so many more units under construction today nationally than there were at that time that I think there's some lease-up concern that I have from those new builds.
Well, Sam Tenenbaum, thank you so much for your awesome insights into the market and joining us today on the podcast. We appreciate it and always love having conversations with you. We'll do it again.
Thanks for having me.
Yeah.
I can't wait to do this again. This is really fun. I really enjoyed myself. Thanks, George. Thanks, Cameron.
Yeah,
Thanks,
no
man.
problem. Well, thank you guys for spending time with us today. We hope you've gained some valuable insights and had a little bit of fun with us. And as George always says, you're only as good as your next deal.
Amen. Thanks,
See you guys.
Bye-bye.
Bye.
Thanks for tuning in.
Stay in the loop by hitting that subscribe button.
and check the show notes for additional resources.